Hello to all, and thank you for joining us from all over the globe today. I hope you and your loved ones are staying safe. I am Anis Ali. I look after NRI products with ICICI Bank, and we are delighted to welcome you all today. Today, we shall be talking about a story we all love, the India story. In this, we will cover the economic dividends and structural measures driving its growth. Now, to share his thoughts and insights on this complex subject, it is our pleasure to have with us today Mr. Pankaj Pandey, who heads the retail research at ICICI Direct and has been with the ICICI Securities for past 20 years. Under his leadership, the ICICI Direct research team tracks over 100 companies across 16 sectors in the large, mid-cap, small cap, and micro cap universe. He also leads the technical and derivatives desk. So with this brief introduction, I will now request Mr. Pankaj to take over. So over to you, Pankaj.
Thank you, Anish. Hi, all. A warm welcome to you all for this investor session. I'm Pankaj Pandey and I represent the retail research of ICICI Securities. So for today, I'll broadly talk about the India story, which is the strongest ever we have seen up till now. And India is experiencing a structural transformation, and because of which we feel that the growth looks a lot more durable than what we have seen historically. So I'll not come to individual points, which is shown in the slide, because all this is sort of well known. But to sort of recap, so demographic is one of the biggest positives which we carry, because we see that a lot of bigger economies are likely to experience deterioration in their demographics, and where the share of the productive population is expected to sort of decline. And compared to that, India is going to have a fairly young population for a good period of time. So that is one of the benefits we are going to have. So India is expected to have population below 30 years, average age of 30 years for a good period of time. The other is macro stability. I think what we are seeing is that a situation where the growth rate, if you look at last 4 years, the GDP growth rate has been in excess of 7%. The inflation has been in the range of 4 to 5%. And so Forex has been, or the currency has been quite stable. And this is to do with the fact that in 2016, RBI had come up with a policy. So they adopted an inflation targeting framework. So wherein they said that the inflation target will be 4% plus and 2 and minus 2. And largely the inflation has sort of remained. And when the inflation is stable, your most of your macro parameters remain stable. And at this point in time, if I have to just highlight, the repo rate is about 6.5%, which is what the money banks typically get from the RBI. And whereas the inflation is 4.5%. So if you look at the real positive rate is about 2 odd percent, and historically 1 to 1.5% real positive rate is a sort of a norm or template which we feel is going to be followed. So from that perspective, we are quite comfortable with the fact that there could be a possibility of a rate cut at of about 50 bips or even more. And I think this year monsoon also is good, so that is also going to help. The other factor is the debt to GDP ratio. So I'm talking about private debt. So wherein we talk about corporate plus household debt. Now this debt is about 50%. Compared to that, the global average is about 145%. So India is definitely a far more better place there. And I think what it tells us clearly is that the corporates as well as the individuals or household can continue this consumption for a decent period of time without too much of a stress on their balance sheet or respective balance sheets. Now, another two global trends, what you will all notice is one is the deglobalization. I think post-COVID, what we're clearly seeing is that a lot was riding on China in terms of sourcing of materials and a lot of it. Now these supply chains are getting tweaked, and our sense is that this phenomena is going to help us, because if you understand, ours is more of a service-led economy. Manufacturing was something which was never there. But I think with this deglobalization, our sense is that India is expected to be a beneficiary of this. And one more change or structural transformation, what we are seeing is decarbonization. So if you look at most of the global economies have given a certain timeline for achieving this decarbonization goal. Now, for India, it is relatively positive because when you look at, we haven't really built that kind of a capacities. The legacy capacity is relatively less in India, and which is why the transition from towards the decarbonization for a country like India is looking a lot more better. And so from that perspective, these are the factors we feel that is going to have a positive structural rub-off effect on the overall economy. Now, it's not that these are the only measures or transformation which are going to sort of benefit the country. Now, we have seen a lot of reform measures being taken by the government. One of them obviously was taxes. So we have seen that on the indirect taxes side, the GST was introduced. And if you sort of look at the collections, it's been a success up till now. Digitization is another story which is the highlight of India. And we have seen ample examples of digitalization reaching to households or in the remote areas. And if you look at what we have also seen is that a lot of welfare schemes run by the government is actually driven through this digitalization platform or the digital ecosystem what the country has created. So coming to say taxes, when you look at this is just to highlight the GST numbers. So GST was launched in 2017. And if you look at, so this is the monthly collection numbers I'm just highlighting, which is there. So if you look at when it was introduced from there on, the tax collections have actually doubled. And this speaks volumes about the success of the GST platform, which the government has come up with. Then IBC is another big reform, which is brought in structural changes in the economy. I mean, when you sort of look at IBC, financial services sector always had this challenge of, every business will witness multiple cycles. So you'll have good cycles and you will have bad cycles. On top of it, we had specific issues where promoters or companies were not really displaying good behavior from a borrower perspective. But I think in IBC, with the introduction of IBC, a lot of this has changed. We see good behavior sort of, or the behavior of the borrowers has definitely changed because no one wants to lose control of their company. And the other thing is that we are seeing that a lot of cases are getting withdrawn because the promoters, obviously, they do not want to lose control of their company. So you see a lot of settlements also sort of happening. And that is also a sort of a measure or a benefit which is very positive because banking for any economy to do well has to sort of be in the right and good shape. And luckily, I think if you look at overall, our sense is that this is the best time what we are seeing for the Indian banking as an industry. And RERA is another segment or legislation which the government had come up with. Now, what you're sort of probably seeing or noticing in China is India had already sort of gone through a decade back. And so real estate sector is obviously a very important sector because it is one of the largest employers of unskilled labor, especially in India. And here what we have seen is that post-RERA introduction, we see that the overall project completion timelines or the kind of money which used to get shifted to some other projects or the diversion of money which used to happen, I think has literally stopped. And as a result, what you see is that the overall real estate companies are diversifying into multi-markets. Otherwise, most of the real estate companies used to be a single market kind of a company or single city kind of a market what they used to chase. So from that perspective, these are the structural reform measures which the government has come up with, and that has sort of really lifted the overall economic outlook for the country. And mind you, real estate has multiplier effects on number of sectors, be it paint, be it home building products. So a number of sectors do tend to benefit from the upturn or upswing what you see in RERA. Now, coming to corporate earnings, so what we have seen is that there was a point in time when the entire banking as a system was struggling. And I'm just highlighting the Nifty EPS from a period of, say, 2017 to 2020. So that point in time, since banking is a very big chunk of the Nifty, which is the main index, 1/3 is typically contributed by Nifty, by bank or BFSI as a segment. Now, that segment, the earning growth was literally not there. So EPS growth was about 1%. In fact, a lot of PSU banks were making losses that point of time. But things like a highlighted post IBC have started to change. Banks have cleaned up their balance sheet. The asset quality is at a 12 or asset quality is at a 12-year low. So from 12-year high, so from that perspective, a lot of things have changed, and that is clearly reflected in the overall earnings. And so from FY20 to 23, we have seen India benefiting from lower commodity prices initially, plus the overall improvement in the asset quality of BFSI that supported earnings, and earnings actually doubled from those levels. But now from here onwards, our sense is that we are going to see a more normalized earnings growth of about 15-16 odd percent, or probably 14 to 16% kind of a range, if I have to take it conservatively. One obvious question is that if the earnings are higher, are we at the peak of the earnings? This is just to highlight that 2003 to 2008 was one of the best times for the markets and even for the corporate earnings. So for example, for corporate profit as a percent of GDP, that point of time, the high used to be about 6.4%. Currently, we are sitting at about 4.9%. So we are still not there in terms of the overall corporate profits being at elevated levels. So there is enough headroom for the corporate profits to sort of inch up, and which is why we feel that the best of the profits are yet to sort of come. And which is what I'm sort of showing in even sectorially also. For large caps, again, if you look at 4.4 was the previous peak high, the profits as a percentage of GDP. Now it's 3.6%. And I think for mid caps, we are closer there, but small caps, we are about 50% lower than that. Now, one more thing, what the government has done in the recent past is that since we are witnessing we are anticipating a shift in the supply chain, the government has come up with a lot of PLI schemes. So PLI scheme is basically, for example, if a electronics good manufacturer is facing a cost disadvantage of 5 to 7 odd percent because of some measures or some benefits being given by the Chinese government or any other respective government in their local country. So to sort of remove that or to sort of neutralize that advantage, the government has come up with a PLI. And the overall aspiration is to sort of give benefits or PLI scheme is to the tune of about 2 lakh crores. And in that process, what we are aiming to achieve is about the $1 trillion kind of overall India's exports, which is what is looking at. In addition to that, what is also being targeted is that a lot of imports or import substitution is being aimed at. So PLI is another scheme where the overall manufacturing leg of the economy is expected to sort of benefit from. Now, premiumization is another thing which is sort of going on because when you sort of look at what we are sort of clearly seeing is that the GDP per capita is expected to double to about $5,500 by 2030. and households which are going to have an income of greater than 3 million rupees, I think is expected to sort of double from 14 million to about 35 million. And this is quite a sizable chunk if you look at from the overall consumption as a perspective. And even if you sort of look at households earning between, say, 0.5 million to 3 million, that number is also expected to jump up by nearly 60 odd percent. And we are clearly seeing some of this premiumization in consumption categories like hotels, hospitals, or even in autos, where we are seeing that there is a 50% jump in the average selling prices or average consumption for a particular category, what we have seen, because people are buying better brands or buying more premium products. Now, while the overall India story looks quite good, but there are some sectors which we feel will do relatively lot more better than what other sectors would do. And why we say is that sectors which are looking extremely good for the next decade is obviously the capex, and I'll come to the reasons for the same. In capex, we are structurally liking infrastructures, core sectors like cement and steel, and I already highlighted structural measure beneficiaries, which is the banking and financial services, along with real estate. And then, since decarbonization is going on and it is going to have an impact on two major sectors, one of them is power, the other one is auto. So these are the other two sectors which are going to benefit. Now, capital expenditure to GDP is at an all-time high level, and we have seen that in the last 4 years, the allocation from the central government has grown at a CAGR of 30%. So, and bulk of this capex has been done or is being allocated towards only two segments, which is road and railways. So, for example, if 11 lakh crores is expected to be sort of spent, 50% of that is spent on road and railways. And this is sort of doubled in the last 4 5 years. And individually, both road and railways are getting a similar kind of an allocation. And both are extremely important because when you are introducing PLI, or if there is a expectation that you will see changes in the supply chain, what is required to tap that opportunity is to sort of have that kind of a physical infrastructure, and which is where the road and railways come into picture. And we already know that India is not really great in terms of logistic cost, because logistic cost as a percentage of GDP is about 14%, which is fairly high, and the government wants to really sort of bring it down to half. So I think what government has been following is this productive template of spending on core infrastructure and not really doing anything which has got less productive impact on the economy. In fact, spending on road and railways definitely has a multiplier effect on the overall economy. Now, when you look at the capex as a trend, when overall last year the capex was somewhere about 26 trillion rupees, and like I highlighted, the central government was doing the heavy lifting by contributing about 10 trillion rupees. The state as well as the private sector capex is also sort of picking up. And our sense is that the commentary from the private sector is getting a lot more better. And we are seeing or we are observing that in a lot of high-tech related segments, be it AI, data centers, manufacturing side, I think these are some of the pockets where India had not had much of an exposure, but we are seeing ample amount of cases where things have been shaping up well. I think defense is another sector where we are seeing good amount of indigenization happening. The overall domestic production has definitely gone up. So from that perspective, this entire capex has started to sort of yield fruit, and our sense is that with overall template being the current template being followed by the government, the capex as a trend is here to stay for a decent period of time. I know we have a budget next week, but our sense is that this template or capex template is or capital expenditure template is not going to be altered by the government in a significant way. Now, coming to railways, see, railways had a structural problem in India because while the majority of the earnings is coming from the freight segment, the passenger as a segment was making heavy losses. And since priority was given to the passenger segment, so it was a kind of a situation where things were very difficult for the overall railways, and that sort of led to underinvestment for a long period of time. And but now what we are seeing is that a good amount of focus being there on the railways. So one is there is a clarity in terms of putting dedicated freight corridors, which is where the freight is going to sort of be the anchor driver for that. And from that perspective, the overall earnings of the railways is expected to be retained. And overall, our sense is that we are going to spend about $15 trillion because what we are looking to do is that, see, in India, the share of freight is about 28 odd percent. The government wants to take it to 45% because we all know that railways is a more efficient, economic efficient way of carrying goods. And which is why overall our sense is that capex on the railways is expected to continue. And while the focus is definitely on the freight side, but in addition to that, what our sense is that the government is also doing a lot on launching new generation train sets or Vande Bharat trains, and some of it are already sort of flying. So, and this is extremely important for overall economy because understand this, if we are going to put up a investment in core sectors like say steel. Now, for producing 1 ton of steel, you need 3 tons of import for producing 1 ton of steel. So effectively, you need to carry about four tons is the kind of overall volume which is being carried. And for that to happen, you need to have a very efficient railway system. In India, the challenge was that railway used to sort of clock speeds of about 25 kilometers per hour. So with dedicated freight corridors, the expectation is that you are going to see a lot more better speeds for on the passenger side also, and also on the freight side also. So from that perspective, this is another structural measure which the government has been focusing on. Now, road is another segment which has already seen decent amount of runway for or in terms of spend already, even prior to the railways. But our sense is that this is not the end of it. Overall sense is that we are going to see a spending to the tune of nearly $20 trillion by FY32. Now, what the government is looking to do is that any big city within the vicinity of about 100 odd kilometers, one should have a high speed network where the overall speed could be 85 kilometers or even more than that, so that the existing speed, which is 47 kilometers, can be a lot more better. And we have seen, or you all would have experienced that a lot of Western countries, the average speed what a traveler undertakes is somewhere about closer to 100 kilometers per hour. So from that perspective, something is being planned or is expected to sort of garner further attention of the government going forward. And that will entail a massive capex of nearly 20 trillion rupees. And both road and railways, our sense is definitely going to help in terms of keeping or will drive the manufacturing leg of the economy, which is about 15-16% of the GDP. Now, for both the sectors, for both the sectors, which is road and railways, cement is something which is a very core requirement. We also know that real estate as a sector is also sort of doing well. Now, this is another sector which is experiencing good amount of capacity addition. So last 4 years, the capacity addition was somewhere about 87 million tons, and now the expectation is that next 4 years, what is lined up is nearly double of that. And obviously, the capex requirement is about 1.5 trillion rupees. But if most of your segments are doing well, the demand for cement sector is going to be there. And that also means that the capacity utilization for the industry is going to be good. Another positive what we see for cement sector is that there is a good amount of consolidation which is happening. Now, in cement, the top 4 5 players are now contributing nearly 60% of the capacity because of the past M&As being undertaken by the top 1 and 2 player, which is the Ultratech Cement and the Adani Group. So from that perspective, you see furthermore capacity consolidation which is going on. And besides that, the demand environment is looking a lot more brighter because now real estate as a sector is also sort of doing well. So demand expectation is growth expectation is about 8% CAGR. And our sense is that these kind of capacities probably will fall short, and we may need further more capacities to be put up. Now, steel is another sector. While it's a big global sector, because when you look at the overall world production is about 1800 plus million tons. China is obviously a good chunk of it. But if you sort of exclude China, India is the only country where you will see double-digit kind of a growth rate. And obviously, if we are going to spend more on the core infra, which is what the country is doing, you would require more steel. And which is why the country or the top 5 players are putting up a significant amount of capacities. So the steel capacity is expected to sort of double by 2030. And the capex requirement for this is quite huge at 10 to 11 trillion dollars. And we've already seen that the capex by the top 5 listed companies that is sort of also doubled from 250 billion rupees to about 500 billion rupees. And I think the only challenge what you feel or what we are experiencing in steel is that China, because the growth rates are slower, they are still dumping a lot of steel, and which is why the prices of the steel are sort of lower. And that is why you don't see a price performance happening in the sector. Otherwise, this is one sector which is experiencing nearly a double-digit kind of a growth rate in terms of volumes. Now, banking, I highlighted earlier also. There was a point in time when banking was in a bad shape, and it's not only private sector banks. Even it's not only PSU banks, or even the private sector banks were also sort of struggling at that point of time. And that is when the RARA happened. A lot of businesses changed hands, and subsequently things have seen a very good turnaround. And when the things were bad, what we have seen is that it had cascading effect. So one was the overall, when you look at the advances growth or the lending what banks used to do, that used to grow at under 10% because the asset quality concerns were quite high. And growth was low, and banks had to provide or do heavy provisioning, and that led to losses for in the years 2018 and 2019 for the bank. But when you sort of look at from there on, when a lot of sectors got revived, we've seen a credit growth of 15 odd percent in the last 4 years. And when you look at the overall profit, I think from a loss, the profit has gone up or has grown multifold to 2.3 trillion rupees. I'm talking about the banking and financial services sector alone. And one more measure, what we sort of look at is the ROAs. So ROAs for the banks have gone to 1%. So most of the PSU banks or public sector banks have ROAs closer to 1%, and private banks the ROAs are closer to 2 odd percent. So banking is one sector which is in good health, is in very fine shape. Now, real estate sector also had its fair share of troubles earlier. So there was a point in time for 10 years, the real estate as a sector did not do well. And this happened from nearly 2013 to 23. And that point of time, the inventories was so high. So the peak inventory was 55 months. So literally more than 4 years of inventory was there in the system. But I think post-COVID, a lot of things have changed also, and what we have seen is that the overall demand revival, especially in the top seven cities, has been fairly robust. And as a consequence of that, the overall inventories have come down to 15 months, so less than 2 years. And this happened despite the fact that the interest rates have gone up by 200 bips. So while there is an expectation of rate cut to happen, but in the interim the rates had gone up. So despite that, we have seen pretty good demand for real estate. Now the demand is largely coming in the premium segment of the market, but our sense is that when the interest rate decline, which is what we expect in the second half, that is when our sense is that the overall growth in the real estate is going to become broad based. And mind you, real estate is a very important sector from various perspectives. One, I already highlighted that it is one of the largest employers of unskilled labor. Plus, it has multiplier effect on number of sectors like be it paints, be it home building products, or number of other products. So this revival of this sector is extremely important and is coming at a time when I think when you look at a big countries like China is actually sort of struggling on that front. So from that perspective, I think RERA has been introduced at the right time and has led to better health of the sector. Another thing is that most of your real estate companies they used to operate in single geography or single city, but with RERA they know that or they are able to operate in multiple cities, and which is why you are seeing a formalization of this real estate industry. So if I have to share a number, around 2 3 years back, the share of these big players or the known names like Godrej or Oberoi or number of other developers like Brigade or even Prestige. The overall share used to be 6%, and but now if you look at their share has gone up to 20%. But although there is still a long runway for growth for these players, but we are clearly seeing this sector getting formalized for good. Now, green transition is something which is I think a global theme which is sort of panning out, and India is no exception to this. And as I said, we really do not have too much of a legacy thermal assets, so which is why for us the transition is relatively easier. What we are experiencing is that, or what we are about to probably noticing is that the renewable energy component is going to see a dramatic change in terms of the capacity additions which is going to happen. And so, from that perspective, our sense is that this is one segment where you will see the maximum capacity expansion coming up, and that will require a massive amount of capex. So while from 172 gigawatt kind of a number, we are going to go to 466. Now 500 is clearly being talked about, and that requires a massive capex of 25 to 30 trillion rupees. And that has sort of energized the entire value chain, the entire capital goods, the power suppliers or the suppliers of transformer cables, all of them. And expectation is that this is one theme which is going to be there for the next 10, 20 years. Because for decarbonization, massive amount of capacity is required. And especially the renewable energy capacity, the likes from wind energy and solar energy or a combination of these two is definitely being looked at. And our sense is that when you speak to companies, capacities are booked for the next 2.5 years. So from that perspective, the demand angle here also is quite strong. Now, one more subset of decarbonization is the green hydrogen, and I think India enjoys certain inherent advantage. So one is obviously the solar radiation in India is decent, and since our solar power cost is lower, so there is a good chance that India can be a significant producer of green hydrogen. And what is expected is that when you look at the global demand for green hydrogen is expected to be about 100 million tons, and India is looking to sort of eyeing for about a market share of about 10 odd percent. Now, for green hydrogen, obviously good amount of renewable power is required. So this segment also will entail a good capex of about 14 trillion rupees. So from that perspective, this is another sector which is looking segment which is looking good. And this segment has seen the maximum amount of capex committed by two big conglomerates. One obviously is Reliance, the other one is Adani. And we are seeing a lot of companies also sort of entering into this way, because I think if India is able to crack this cost bit, we can be a good global supplier for this new energy source. And that has the potential to sort of change the dynamics for our market. And why I say so is that, see, we import about our crude oil bill is also something, say, about 10 trillion rupees on an annual basis is what we spend on crude oil. And if we are able to sort of produce something like green hydrogen, we can obviously lower our import bill, or would not allow to sort of increase the way it used to increase. And it has multiplier or multiple effects on your interest rates, currency, inflation, so all of it. On top of it, if we become exporters, so then the tide will turn in terms of this. This can become one of the big export categories, which one can, which we haven't yet seen. Because besides software, this can be one segment which can become a lot more bigger. And I'll not be surprised, because when you sort of look at big conglomerates like Reliance, so I mean, they're putting money in the entire value chain. So if they're able to crack this cost aspect of this, then things look quite bright, especially on the green hydrogen front. Now, I spoke about premiumization. In premiumization, if you sort of look at most of the segments, the sales are lifetime high. So two-wheeler was the only category which was struggling, but we have seen that segment also making life high. So all the segments, be it PV, CV, all CV ideally will make new high this year, but overall most of the segments are making new highs. And the way I was sort of saying is that the average selling price of the industry is on the rise and has seen 50% jump. So a typical spend on auto used to be about 7.65 lakh per unit. Now that has gone up to 11.5, and the reason for is that the entire market had shifted from sedan to SUV market, and so SUVs are now 52% of the market share. And most of the vehicles you will see alloy wheels or panoramic sunroof being a standard feature now. But this is not the end of it, because luxury as a segment is still very small in India. I mean, it's at 1% compared to 10% is what you see for a lot of bigger economies. So there is a long runway for growth on the premiumization bit. Now, how's our market sort of stacked up to sort of tap this opportunity? Now, one is obviously most of our large cap index, mid cap index, or small cap index, they are already sort of doing well. We are one of the best performing markets in the last 1 year or even for some time frame. Uh, but before I come to that, correction is a very inevitable part of the market, and correction happens or can happen through multiple factors. So rather than sort of highlighting risk factors, because see, domestically risk factors are not so high. Globally things can happen, but just to highlight that, say since 2007, every year you will see large cap, mid cap, small cap will witness a correction. So large cap obviously will witness a lower correction of 10 to 12 odd percent. Mid caps slightly higher in the range of 15 to 20 odd percent, and the small cap will obviously witness even more steeper correction. But that is how the risk reward is sort of stacked up in across large caps. It largely depends on what kind of risk appetite one comes up with. But just to highlight is that there could be a risk factor which could drive this kind of a correction. But India overall looks quite well placed to sort of ride the opportunity which is in front of us. And uh, next 8 to 10 years, what we see is that India is expected to be a $7 trillion economy. GDP growth rate is expected to be 7%. I already highlighted that last 4 years we are seeing 7% kind of a growth rate. And what this also means is that with inflation of say 4%, 4.5%, the nominal GDP growth rate could be 11 to 11%. So if I am saying that 12 to 15% kind of a earning growth is very much possible in equities, it's not a very high expectation or which we are sort of anticipating. And obviously, since we are going to have a pretty young workforce, or 25% of the global workforce, and we are already seeing a lot of global MNCs putting up capability centers in India, the kind of decisioning which is sort of gone up. So from that perspective, this is what we see India shaping up in the next 8 to 10 years. And to sort of sum up, one, we are very bullish on the markets, something similar to 2003 to 2007 kind of a scenario. Coming from two perspectives. One, I already highlighted that that point of time also the real estate as a sector with multiplier effects on the economy was doing well. And same is the situation now also. The other one was that the capex was also good, and this time also we are seeing capex or more productive capex happening on core sectors, and which is why I feel that India is going to experience one of the highest or better growth rates. And on top of it, obviously, you have other benefits coming in. So with the inclusion in bond index, we are going to tap global savings as well. So combination of all these factors plus steady earning growth makes us believe that India is going to offer durable double-digit growth going forward, and it is one of the best placed markets globally for the next 5 to 10 years. So which is why we are extremely bullish on the markets. That's all I have to say. Thank you so much.
Great. Thank you so much, Pankaj. That was, very interesting presentation. And I'm sure that this initiative provides numerous opportunities for the NRIs to gain a comprehensive understanding of India's economic growth. And accordingly, they can take a more informed decision with their investments. So now we will move to our Q&A session where, we have received close to around 2,000 questions from people who have joined us on this webinar. But due to time constraint, we will not be able to cover all, but I'll try and ask you some of the most, relevant questions here.
Sure.
So the first question, you mentioned on Nifty, with Nifty at 25,000, around the corner, what next? Do you see Nifty at a bigger level at, let's say, around 40, 50,000 by 2030?
So, Anish, if you sort of look at FY25 or 2025, overall Nifty EPS is somewhere about 1070, closer to 1100. And I already highlighted that 12 to 15% kind of a growth in overall Nifty earnings is very much a base case kind of a scenario. So even if I am assuming a 12.5% kind of a growth rate, I think Nifty EPS could be 2000 by 2030. So from that perspective, Nifty can already sort of double from current levels from here on, or closer
Sure.
to about 40 to 50,000 kind of a levels. And I think India is commanding rich multiples because there is a decent amount of comfort in terms of the durability of growth. So earlier you could look at only 1 or 2 years, but now you are largely sort of getting comfort that this growth or the kind of measures being taken will have a long-lasting impact on a number of sectors, and the benefits of some are clearly visible. So 40 to 50,000 kind of a Nifty is definitely possible.
Wow, fantastic. Great. So the next question is, what are your current sector favorites?
So I already highlighted that. So for example, from a shorter term perspective, it could be banking, which is looking very good. But uh, uh, I already highlighted that for the next, say, decade or two, I think since we are going to spend on capex beneficiaries, be it infra companies, capital goods companies, cement and steel being core sectors should do well. And to
Right,
fund that, obviously banking is required. And then you have energy transition, which is a big sort of a theme. So entire power as a sector and auto should benefit. And
right.
banking is already I highlighted.
All right, all right. Perfect. So what is your outlook on corporate earnings?
So our sense is that see, if you look at last 4 years, the earnings have doubled, and from there on, our sense is that the earnings are going to get more normalized. So about
Correct.
15% CAGR is what we would expect. I am hopeful that things can become or things will become better, but I think we still need to see because private sector, the overall commentary is getting quite better. So if that capex from them picks up, then I
Hmm.
think these numbers could definitely be better. Or if the interest rate sort of declines, I think
Okay.
so. That is another factor. But I think on the corporate side, one thing I would want to sort of highlight is that, like you see for banks which are in the best of their health now, even the corporates, if you look at, except for telecom sector, most of the
Right,
sectors, the balance sheets are very good.
right,
Something
right.
which I have not seen for a very long period of time.
Hmm. Okay, makes sense. Great. So the next question that we've got is that, the initial readings on Q1 FY25 results. Do you think IT is a turnaround for real?
So I think IT, the challenge is that when you look at during COVID, companies thought that online is the way to sort of do business. So which is why the vendors or the companies went, I think, overboard in terms of tech spending, and that sort of led to a heightened demand or a good demand for IT companies. And last 2 years has been a sort of a cooling off period for IT companies. And recent commentary or recent numbers, if you look at, one, the worst is behind because no, so worst is behind us. But the pace of
Right.
improvement is still not great enough, and improvement is expected in FY26. Obviously, there is a market. What is also sort of factoring is that in US there is a good possibility that if the Trump is going to come, we might see two
Uh-huh.
more rate cuts happening, and that
Yes.
has a positive rub-off on the will have a positive rub-off on the IT because banking there is one of the biggest tech spenders. And if the interest rates come down, probably their capability to sort of do more of discretionary spend will go up, and that will have a positive rub-off on Indian IT companies. So worst is behind us. Pace of improvement, I think we need to sort of watch it out for. But what companies are clearly saying is that not in 2025, 2026 is where they see things getting normalized.
Okay, great. So it's a good view. A long-term view is always very positive here.
Yes.
So the next question is, the street has turned relatively positive on large caps versus mid caps and small caps. So what is your market cap preference?
So I already highlighted that large caps offer less correction, offer lesser upside. The mid caps offer slightly higher correction and slightly higher upside, and that is how. In the best times, 2003 to 2007, the Nifty jumped 5x. The mid cap and the small cap index did 9x. Now, it all depends on what kind of risk appetite one carries. Because see, universe for
Sure,
mid
sure.
cap and small
Yes.
cap is fairly large. So large cap is only top 100 stocks. Mid cap is another next 150 stocks, and then the small cap universe is 4,000 plus stocks. So not all stocks are valued in a frothy manner. Our sense is that there are a lot of stocks which are looking attractive from that perspective. So it all depends on what kind of risk appetite one carries. I am liking all the caps.
Excellent. Okay. So while we're talking a lot of positive things now, there's this one question, which is which sectors would underperform in the coming year?
So there are some pockets which we are sort of not expecting to structurally outperform. IT is one of them. So while
Mhm.
IT will sort of normalize, but normal growth for IT is 5 to 7%. And
Right.
uh, and since our economy is doing well, gone are the days when the currency used to depreciate 5%. I don't think that is going to happen. At least in the recent 1 or 2 years, we have not seen the currency depreciating that way. So IT is going to deliver single-digit growth. Now, if my overall Nifty earnings are going to grow at 12 to 15 odd percent, so IT growing in single digits, not getting help from the rupee depreciation is going to underperform. So
Right.
while the sector is good, has done well, but I would want to believe that structurally it is going to underperform. The other one is FMCG as a category or categories which have done very well historically. So FMCG did very well because most of the segments of the economy was not doing well, and which is why I would want to believe that FMCG as a segment is going to underperform. Similarly, companies which were sort of gold templates. So, for example, in banking or for example in NBFCs. So you had Bajaj Finance. So Bajaj Finance was the only retail NBFC. You had all the
Mhm.
NBFCs were wholesale NBFCs. So I would
Right.
want to believe that most of the NBFCs are changing color. So from that perspective, the historical outperformers may not really repeat their performance. Because market is now open for a lot of other sectors, a lot of business models have improved or changed for better.
Yes, yes, absolutely correct. Yes. Okay. So the next question is, what is your outlook on interest rates, both domestically and globally?
So globally, it's a bit difficult to say, but I think what is coming out clearly is that two rate cuts this year looks is a case being built already, and I will not be surprised if there are further rate cuts because see in US the real positive rate is still quite high, and I think a change in leadership there might trigger further interest rate cuts there. So US is expected to witness softer rates. Then I think in India, our sense is that rates are expected to come down. So one is the inflation linked, which is what the RBI framework is. So our sense is that with monsoon being relatively decent or good this year, there is ample room for 50 to 75 bips kind of an interest rate decline. On top of
Okay.
it, if we get a decent amount of flows through the bond index inclusion, then it is possible that the interest rates in India could decline by at least 70 bips, if not more. Because I think what we are clearly seeing is that RBI probably will be comfortable with 1% kind of a real positive rate. So, for example, if my inflation is 4.5%, so repo rate can be at 5.5%. Currently is 6.5%.
Okay. Perfect. So as you just mentioned about the sovereign debts being added, in the index, the global index, what kind of inflow is expected, and how will, it benefit India overall?
So one is see India historically has this challenge was that why you could not grow faster was that you had limited domestic savings and those were sort of channelized for various purposes.
Mhm.
So we had very less of foreign savings and whatever foreign flows used to get was largely in equities and that used to be volatile.
Right.
But what
Right.
you're going to get now is more stable flows of 25-30 billion dollars at least, and that has the potential to sort of improve the overall saving pool of the economy and lead to softer interest rates. So crowding out of investment used to happen earlier, but I think with this kind
Mhm.
of an inflow, your capability to keep interest rates lower is going to be far more higher. And what it also does is that it benefits the other asset class, especially equity, because if my cost
Okay.
of debt is less, my cost of equity is also going to be lesser, which means that a lot of
Agree.
business become viable at lower interest rates, which is what the Western world sort of experiences. India has never sort of experienced that. So from that perspective, it's a big shift which can happen.
Right. That's an excellent advantage for India, as I also see it. So while you've already reiterated on the upcoming union budget, but what are your key expectations from it?
So we all know that it's a coalition government, though it's a strong coalition. But I
Hmm.
think see, I already highlighted that capex template or capital expenditure template is going to be maintained, and I don't expect any surprises there.
Right.
What needs to be watched is that is there any or the extent of populism in the budget? Because when you sort of resort to populist measure, these are short-term measures which might sort of prop up the consumption or might help the economy in a shorter duration. But really,
Right.
no structural benefits is what it accrues. So we need to see that to what extent the government gets there. Uh,
Hmm.
I hope they'll not do much, but very much possible. And I think overall budget is becoming a sort of a non-event because you see most of the big announcements are related to PLI or a number of other factors. See the GST, you have a GST council which takes a decision independent of what happens in the budget. So a
Correct.
lot of things are beyond budget now. So it is becoming a more of a sort of a non-event. But I think for me, the key takeaway would be fiscal deficit if it is being maintained, discipline being maintained, and the awareness element of populism.
Excellent. Great. So I think we'll take one last question before we end the session. The last question is, FIIs have turned bullish recently. Do you see this trend continuing, and what drives this positive momentum?
Oh, yes. So if you look at FI inflows in the month of July is about 25,000 odd crores, a significant number. Now, what is driving
Hmm.
is again, we need to sort of look at two, three things. One, I think there was an expectation that you'll see China doing better, but Chinese growth has been sort of faltering. So within emerging market, we are clearly definitely the choice. I think the only challenge with India is the multiples are rich. But I
Right.
think our sense is that with the anticipation of rate cuts in the US, the risk on mode is there, and which is why the inflows will come. And inflows
Hmm.
typically benefit two sectors. One is the banking, and the other one is IT, because these are the two pockets where the maximum inflows get soaked domestically, and which is why these
Correct.
two segments will benefit from there. And our sense is that inflows are going to probably come into India. I think FIs have been sort of missed a decent part of the rally in the last, I would say, 12 to 24 months. Something
Right.
which the retail or the HNIs have sort of lapped up. So FI inflows has started to pick up and is going to get better with the decline in interest rates going forward.
Fantastic. Great. So with this, we come to the end of today's session. We hope you found this session useful. We also have a feedback form for today's session, which will appear on your window. And I would request all of you to take a minute to fill the form to help us make our sessions more insightful and relevant to you. Thank you so much, Pankajji. It was a fantastic session with you. Lots of doubts were cleared and very insightful. So thank you once again.
Thank you so
Guys,
much,
as I
Anish.
mentioned, yeah, as I mentioned earlier, we will bring more high impact sessions on multiple topics in subsequent months. So thank you very much for being with us today, and we look forward to seeing you all in the next webinar. Until then, please take care, stay safe, and bank on us. Thank you once again.